Hello, hello, everybody. How are we doing? It's Tuesday. I hope you guys are doing really, really well. My name is Jason Krutzky. It's a pleasure to be back with you. It's been a minute since we've been live, and couldn't think of a better day to be live than today. And why is that? Well, obviously, because it is FOMC day. It's a big day in the markets. Yesterday was a big day in the markets as well. We had the CPI print, which came in cooler than expected. Price action was a little crazy. You know, they really bought it up onto the print and then immediately sold it off. Sold it off the entire day. Kind of not what I was personally expecting. I'd be curious to know, to those of you who are tuning in today, what you guys thought about the CPI print yesterday. Were you surprised by the number? Were you surprised by the price action? Did you expect it all? And the way it went down, I would love to know. Thank you guys all for tuning in. We've got a really exciting, thing that we get to do today. We get to hang out with Jerome Powell. It's not every day we get to hang out with that guy. He has been the decider of the fate of the markets as of late. So I would expect today to be no different. You know, what we're hearing, and at least what I've kind of seen and what I've read, the market is pretty much expecting a 50 bips rate hike. That's going to be a little bit of a cool down from what they've been raising. They've been doing 75, so 50 is a nice change of pace, potentially. It might be. I put that in like stars and quotations, might be signaling the beginning of a cooling period for their interest rate raises. And, if you are bullish securities, this is what you want to see. Now, there are those out there that certainly are suggesting we have a lot farther to go to get numbers down to the optimal rate that they're looking for. The the CPI print yesterday was 7.1%. And the target rates that Jerome Powell and crew are kind of looking for are quite well below that 7.1%. So there's a ways to go. And we don't know if this is the beginning of the end or not. And when I say the beginning of the end, I mean of their raises. But if this is the signal to the beginning of the end, then, we as traders, we as investors should be very, very keen to start, really kind of picking apart the charts and trying to find the next leaders, two, trying to kind of figure out where we want to start positioning ourselves if in case the bottom is in. And we're going to talk about all of that later. I've got some awesome goodies that I'm going to share with you guys. We're not going to do it until after Jerome speaks, so it's going to be a little while. But in the interim, first thing I want to do, I see there's a bunch of you guys here. I would love for y'all to say hello. Nobody has spoken up in chat, and I would love to say hello to you guys. Oh, well, hold on. Maybe they have. Nope, nobody's in chat. So hit me up in chat. Let me know your name. Let me know where you're from. I really thank you guys for being here with me today. Also, let me know if you're a TrendSpider user. We've had some crazy sales going on lately. We've had a ton of new people join the platform. So if that's you, if you're new to the platform, you signed up maybe because of our Black Friday sale, or maybe you're taking advantage of our Christmas sale, or our holiday sale rather. Thank you so much for doing that. And, say hello. I'm always happy to answer any questions about the platform that anybody has. I want to take some time here. We're going to get the FOMC, the announcement we're going to get in about 25 minutes, what they're raising. How are they raising? And then Jerome is going to come on 30 minutes after that. You can see in the little box above me, that's going to be a live stream of Jerome. We are going to turn off the music. I am going to be silent, and we are going to pipe in just Jerome. We're going to give him front and center so you guys can watch along with me. I'm just going to look over here on chat. White Horse, what's up, White Horse? What's up? It's Kev. How's it going? Jeff, how are you? Gwen, how's it going? Potent God, what's up? ABCD, how's it going? Here to sell bottles of farts. You've got a good sales tactic, sir. So thank you guys all for being here again. I wanted to take like I said, I want to take the next 20 minutes or so. We've got about 25 minutes until we get the announcement. Once we get the announcement, I'm going to zoom into like a 1-minute chart or a couple of 1-minute charts, and like we'll just watch price action and kind of just see how things are playing out. But before that, I want to take some time. I want to utilize a bunch of the tools on TrendSpider to kind of like assess where we're at on the indices. So we're going to look at the Qs, we're going to look at SPY, we'll look at IWM, maybe we'll look at DIA as well. Awesome, Potent. That's great. Congratulations on your new trading journey. I wish you the best of luck on it. I hope you find some of these tools helpful. I certainly find them helpful myself. So we'll start on the Qs, and I've got some basic stuff up here. You know, I've got my 200-day moving average. Everybody's talking about the 200-day moving average. Obviously, it's a huge moving average. I don't think I need to explain it. If even new traders like yourself, Potent, you guys even have heard of the 200-day. So really, I like it on my charts because it just tells me where price is in relation to it. You know, I know everybody's watching it, so I want to know where it is. On the Qs, we're trading pretty well below the 200-day. That's at about 303. We're trading 290, so it's got some work to do. We've got, on the TrendSpider platform, we've got a handful of tools, and this might really serve newer traders who aren't really sure how to utilize some of these basic tools. First off, we have the auto trends. Auto trends are going to automatically draw trend lines on the charts for you. And the reason why I like this tool, even as a relatively seasoned trader, I've been trading for some years, I'm pretty decent at drawing my own trend lines. However, if you draw your own trend lines, what often is going to happen, no matter how long you've been at it, bias can come into the equation. And so for me, I really like the auto trends because they can take that bias out. They're just using sheer math to tell me the most powerful trend lines that are occurring on the chart at any given time. And, you know, they're very clear, especially on these bigger time frame charts on the indices. These trends, the trend lines are very, very clear. You can see them almost without seeing them, but having the visual reference and having a tool that you can just press the button and it does it for you, I love that. So, you know, for me, obviously we are pretty well below some of these clear trends. The one that I've kind of been paying attention to is this green one here. Oops, I clicked the wrong one. There's a couple of different ways that you can adjust these. You can hold shift and click on them and remove the ones you don't want. You can double click on the ones you want and they'll stay on your chart. So this is the one that I'm watching, this blue trend line here. And obviously it has, it's running in tandem with the 200-day moving average. I love using the auto fibs because the auto fibs allow me to, you know, if you're not a fib user, hold on one second. We got a question here. How do we add the 200 to our charts? Oh, yeah, Potent. In order to add the 200, you would just click on the 3 dots next to this indicators button here, and then just search simple moving average. You would select it, and then it'll come up in your list, and you would just want to change the length to whatever length you want, and then say apply. So with the auto fibs, you know, I'm a price action guy. I know that a lot of bots and a lot of high frequency traders and these sorts of things, I know that the fibs are just as kind of important to a lot of traders as something like the 200-day moving average. So I'm always keeping the fibs. We're getting caught up at the 50% retrace of the most recent swing high to low here on the Qs. If we were to go to the weekly, it's going to measure, it actually didn't measure the same, or it did measure the same one. Another fib sequence that I'm kind of looking at here is, and I'm just using the fib drawing tool for this, is the one from COVID low to high. And you know, we caught a bid right at the 618 retrace. Again, another powerful fib level. And this was weeks and weeks ago, this was a couple months ago, but it's something to pay attention to. And now we're kind of trying to break above and hold and really hold above that 50% retrace from the COVID low to high. On the right-hand side here, and again, a bunch of additional kind of more fundamental like tools to help with analysis. We've got seasonality. Seasonality is just how does the stock perform throughout time, right? In this particular case, I have it selected for months of the year, and I can pop this out so we can see. So this is just performance of the Qs and on monthly time frame, and when I say performance, it's just looking for is the month green or is the month red? If the month is green, that's a tick in the positive column. If the month is red, that's a tick in the negative column. And so this is looking back to 1999. So you're talking about 23 years worth of data here. And as many people know, we are in historically strong periods of time, right? I see we're already getting a little bit of a move ahead of the announcement. So with seasonality, we like to use this as kind of a barometric gauge for, you know, how strong do we expect this stock to react, or how strong do we expect this name to be. And we can see that November is generally the strongest month of the year. That strength kind of falls off quite a bit in December, picks up a little bit in January, and then we have our weakest month of the year in February. So we're coming into that Santa rally time, that strong period of the year, and then it's followed by the generally weakest historically time of the year. So it's something to be mindful of. And something I pay a lot of attention to, kind of where are we seasonally. We've also got the unusual options widget. And for anybody who's not yet a TrendSpider user who's interested in the tool, all this stuff comes standard with all of our plans. So, you know, it's like with something like unusual options, it's not uncommon for folks to pay, you know, entire subscriptions, monthly, yearly subscriptions for just this data. It's just one periphery tool of the platform. So unusual options, the way that I kind of like to use this is I just like to see, you know, what's the distribution. Red is obviously going to be put buying or maybe put selling. Green is going to be call buying or maybe call selling. And I always just like to just get a general gauge of like, where are the options contracts heavily kind of distributed? And is it more distributed towards puts? Is it more distributed towards calls? You know, we can see kind of very clearly here the most of the action is within the first couple months of next year. Down at the bottom, you can see the time. So this is looking out January 2023, March 2023, June 2023, and so on. So most of the unusual options activity is focused more on the current time, like what's going on right now. And we can kind of see it kind of leans a little bit more bearish. The size of the circle is dependent on the size of the premium. So the more premium per order, the bigger the circle. And we could see some very clear large red circles. So those are big put positions. We can filter them by premium amount, by strike price, and by expiration date. So generally I'll come in here and I'll kind of filter out some of the smaller orders because, you know, for a big hedge fund, $25,000 isn't very much money, right? So we kind of want to see where the big orders are, $250,000, $500,000, over $1 million, and so on. So I've got it filtered out here for $250,000. So these are just contracts or just orders that are more than $250,000. And again, we get a bit clearer of a view. Clearly, people are kind of more positioned in the puts. I like to kind of review these and see what puts are they positioned in. Qs are trading 291. I've got a million one premium position here with 310 puts for expiry December 20th. So these are way in the money puts, right? Or way out of the money puts, and so on. So I guess currently from what we're seeing here, we can kind of tell that traders are more positioned in the puts than in the calls. That can kind of help influence our idea of what we can expect. So it's a bit on the Qs there as well. Let me throw up the daily again. I always like to look at market breadth. Market breadth is an indicator that we recently added, and it gives us an idea in this particular setting. What I have here is net new highs, 21-day highs. Stocks in the Qs that are making new 21-day highs. If you have more stocks making 21-day highs, you know, or rather just if you have new stocks making new highs, that's bullish. That's what you want to see, right? In order for the index to keep moving higher, the stocks contained within it have to be making new highs. So as the index is making new highs, you kind of want to see these individual names making the new highs. And we see a little bit of divergence, which isn't really what I was expecting, but it's something to be mindful of. Index has continued to make new highs, and when we look down here at the new highs list of this index, this is the individual names, we see that it's actually decreasing. So that throws in a little bit of concern, right? And Being below the 200 throws in a little bit of concern. Being below the trend line throws in a little bit of concern. Being that the options expiry or the options are positioned more bearishly, that throws in a little bit of concern. Coming out of seasonal strength and into January, February, which are kind of seasonally weaker, that throws in a little bit of concern. We're just trying to we don't know which way price action is going to go. It could go higher, it could go lower. We're trying to use the tools that are available on the TrendSpider platform to give us an edge, give us an idea of, based on everything that I'm seeing here, this is how I'm going to start formulating my plan. If we go to SPY, we'll check it out real quick. Obviously, it's a little bit stronger. It's in a better position than the Qs are, that's for sure. We're trading above the 200-day moving average. We've got this downtrend line from the all-time highs, this green guy. I'm going to remove this red one here. We're trading right up into it. It feels like this FOMC meeting, and we could talk about options expiry at the end of the week as well. We have a huge OPEX at the end of the week. It feels like we're at a very, very pivotal turning point, right? We know that FOMC, or we assume the market is kind of pricing in the idea the FOMC is they're going to pull off on the rate rise. That's bullish, right? And we're coming into these very pivotal areas on the charts where price is just like, what are you going to do? So interesting to see, right? Let's go to the auto fibs here, turn those guys on, and we can see, remember the Qs were below that 50 retrace, and on the SPY, we're well above it. We're even above the 618 of the high to low of the most recent swing. We can go to the weekly and check out what was going on there. These are things that I've kind of been highlighting in my weekly blog. I don't know if you guys follow it, but perfect touch of that 50% retrace from COVID, a low to the 2022 highs, early 2022 or late 2021 highs. Perfect 50% retrace here and finding support there. Now on the unusual option side, let's go check out the unusual option side real quick. A little bit different of a story. On the Qs, the unusual options were more heavily positioned to December. Here on the SPY, they're more heavily positioned into February. So that's kind of interesting to see. You're going to see, well, let's actually do this. Let's try pulling out some of the lower premium. And again, we're still, of course, you're going to have large positions on either side here this week into next week. But this isn't the same thing as we saw on the Qs. The Qs didn't have much already pre-positioned bearishly, or inputs rather, into March. It wasn't as much, there's weren't as many big orders out into March. So that's kind of interesting to see. And then we can go to seasonality here on the SPY. And now SPY seasonality in December, quite stronger than QQQ, right? Qs was at 50% win rate since 1999. Here on the SPY, we're looking back since 1993. We got a 67% win rate on the SPY. So that's something to consider too. And coming into February, March, where the Qs really kind of pull back into February, March, SPY is quite stronger. So that's, again, we're just trying to kind of build some understanding of expectation, not trying to necessarily predict which way price is going to go. We're just trying to build some expectation. If we look at market breadth down here at the bottom, we see pretty much the same thing that we saw with the Qs, right? We see that SPY is continuing to make higher highs, whereas we're not really seeing that on the 21-day new highs. Oh, you know what? Let me do this real quick. I'm just realizing I had the NMS composite. Let me switch this to the NYSE. Yeah, so, okay, here's the NYSE, and it is the same issue, right? We are not seeing net new highs, 21-day highs. And, you may ask, why am I using 21-day highs? Well, 21-day high, 52, you can do all kinds of different highs, right? If you click on this little three dots here, you can choose different series, right? 14-day highs, 21-day highs. Obviously, 21-day highs is 1 month. 64 is 3 months, and continue on, and you can filter it out by 52 weeks as well. And 52 weeks is great, and it is kind of a benchmark. However, 21 days gives us a bit more real-time feel, and so that's why I'm using it here. And And we can really clearly see new highs on SPY, and we're not seeing those net new highs on the individual names. You would anticipate this kind of should be moving in tandem. New highs on SPY should be leading to new highs on market breadth. So something to think about. Let's look at IWM real quick. We got about 10 minutes before the announcement. I want to make sure I'm on the charts when that announcement comes. On IWM, very similar look to the SPY, but trading below the 200-day moving average. We can see it's trading below that downtrend line from the all-time highs there back at the end of last year. If we go to market breadth, let me go to Russell 2000 and grab it. Market breadth, very similar story, right? So this is a through line that we're seeing on all of the indices, right? We're seeing that price is making new highs on the indices over the past couple of months. I mean, we've kind of failed some new highs over the past week or two, but generally speaking, new highs on the indices over the past couple of months, whereas the component parts are not really fitting that same mold. Maybe a little concerning, you know, something to keep in the back of our minds. Let's look at seasonality real quick here on IWM. We see almost like a mix of what's going on with SPY and what's going on with the Qs. Relatively strong December here for IWM. Go over to January and it's the weakest month of the year. So something to think about with that. Let's go to unusual options and a very clear picture on unusual options. I mean, look at this. Like, now you guys have seen a couple of different charts, a couple of different sets of this unusual options data. You kind of see how the distribution of the circles works, right? You can see kind of where they populate, where there's more of them, where there's less of them. Well, this one is a very clear, the market is, it looks to me very clearly bearish, unless this is all just protecting. And it's very possible. It could be hedging. We don't know for sure. But this to me looks very bearish, right? Even you're looking out months and months, you're looking out to even December of next year, and almost everything we're seeing here is red. There's very little green in the equation. So that's concerning. You know, that's concerning if you're bullish on the IWM longer term. We've got about 8 minutes here. Does anybody have any questions about anything before we kind of switch over to watching the shorter term time frame? I want to make sure that everybody's able to get any questions asked before that, if they have any questions. If you don't, that's totally cool. You don't have to have questions. Let me think here. Yeah, so also, kind of how I'm thinking about this, y'all, we have another feature that's available on the TrendSpider platform is multi-symbol view. You can look at up to 16 tickers at the same time. It's its own unique workspace. I'm going to pop over to my personal multi-symbol view. It's right here. You guys can see it now. When there are unusual options, how does one know if it's hedging? That's a really good question, Joel. I cannot give away there. We've got some data coming that's going to give us more insight as to whether it's hedging or not, whether it's essentially buying or selling, right? You can sell a bunch of puts or you can buy a bunch of puts, and those are two totally different directions. The data is not available yet. It's coming. But so for now, we don't really know. There is no way to decipher just using the unusual options tool at this time. There's no way to decipher if it's hedging or not, because we don't know. It's just the orders that are coming in. That's all we're able to show at this time. But we will be able to show very soon kind of more fragmented data about what those orders are. So it's coming, Joel. I wish that I could tell you that we had it right now, but of dark money to unusual options, I mean, the dark pool prints for sure are something to be mindful of. However, as far as dark pool prints versus options, I'm not sure if there is necessarily a one-to-one, right? Certainly you could, if you were a big market maker, you could certainly do some dark pool order for equities and then go and buy the corresponding hedge in options. 100%. I mean, that definitely happens. That's definitely like, that's how it works. But, you know, I don't know if it's always one for one. It's hard to say. Yeah, no problem at all. No problem at all. So, I guess, you know, I'm kind of going to revert to you guys. Y'all are in control here. Would you prefer to watch? I definitely want to stay on the indices. Would you prefer to watch just one kind of full screen, or would you kind of prefer more this triad view where we can kind of see everything moving at the same time? Do you have a preference? If you have a preference, say you have a preference. If you don't have a preference, that's totally cool. You don't have to have one. And I could always, of course, go back and forth, but I want to make sure you guys are getting what you need. You're hanging out with me. Yeah, you say triad, Aaron. Okay, cool. Brandon says triad. All right, cool. Yeah, all right, 2 votes for triad. I say we keep it on the triad. Steven, you say triad. All right, perfect. Yeah, that works for me. Sweet. And, you know, awesome, Gwen. We're going to keep it on triad. That's a unanimous, resounding vote for triad. And if anybody wants to see anything in particular, we can definitely look at it. What I'm kind of thinking I'll kind of, you know, I'll kind of keep my mouth shut a little bit here. We've got about 5 minutes, just so you guys know, 5 minutes before the announcement. Yesterday, when CPI came out, I don't know if you guys noticed this, but like 2.5 minutes before the actual CPI number came out, there was a huge print. Somebody jumped the gun, went long, and so there was a huge like 30-point move. At least on futures, and then it pulled in, and then the announcement came, and then the real move came. So we might see something similar to that here very soon. They might try and, you know, front run the announcement. Somebody might try and front run the announcement. But things seem to be setting up relatively bullishly to me. If you've ever been on any of these shows with me, you know that I'm a price action trader, and when it comes to price action, some very simple things have to occur, right? For uptrends, you need to see higher lows, higher highs, and for downtrends, the opposite. If price continues to hold higher lows, you got to kind of keep on expecting it to keep making higher highs. And we've been managing to hold higher lows for quite some days now. I don't know if anybody's following my Twitter feed, I've been posting a little bit about it, just highlighting what's going on ES, because that's kind of what I trade personally. Yeah, I don't know. We've got 3 minutes here. We're going to get an announcement real soon. Market's pricing in 50 bips is what I'm thinking. Or market is expecting 50 bips. I think it was like 80% chance of 50 bips. So would be surprised to see anything different from that. But again, once Powell comes on, Powell will be on in about half an hour. Once he comes on, that could totally change the ball game. So it'll be very interesting to see how the market reacts here. What's up, Yoakum? Hope you're doing good, buddy. It's good to see you. What are you guys expecting? You expecting everything to be in line? 50 bips hike? If so, where does price go? What do you guys think? Is anybody positioned in a certain way? Or are you guys letting it all shake out? I'm letting it shake out myself. I'm not positioned at all. What's up, Perry? Good to see you. Thanks for being here. Powell stay the course, emphasize CPI data as encouraging. Yeah, I mean, it's certainly possible. He came off, I don't know if you guys were here for the last one of these, but he came off like quite less hawkish in the last announcement. All right, here we go. We're getting a move. If I need to zoom in on anything, y'all just let me know. Want to make sure you guys can see it well. $24 calls, J-Man. All right. Perry's chilling on the sidelines. Robert, what's up, Robert? Good to see you. Ron, puts undefeated. Aaron, you think the daily on SPY is bearish looking, huh? With the big wick? There's a lot of talk about, you know, you fade the initial move, right? The initial move happens and then Jerome comes on and price reverses. I haven't seen enough of these FOMC meetings to really know if that really works all the time. I hate the idea of relying on that idea. Perry's waiting for the pop. Where are we at? We got 1 minute left here. Definitely a lighter reaction initially, just a minute before here. Oh, there goes the Qs. There goes SPY. There goes IWM. All right, so initial reaction is bad. Clearly, I need to zoom out on the Qs to capture that whole candle. Pull in here. So my screens are completely full with items. Can anybody give me some feedback on what the announcement was? Did they come in at something other than 50? 50 bips. Okay, so initial reaction to the expected move is negative. That is interesting. Now, are they going to hold these lows? Let me zoom in just a little bit so you guys can see a bit more price action here. Hikes by 50 bips. Target range stands at 4.25 to 4.5. Interest rates on reserve balances raised by 50 bips to 4.40. All right, so far, we look at IWM here. We're still holding lows. This is nasty looking, but we're still holding lows. Puts undefeated. Ron, there you go. Let me zoom out just a little bit more. If this is too zoomed out, y'all just let me know. So I'm going to hang out here, I'm thinking, on this view just for a few minutes. Let price kind of settle and do its thing. I want to take at least a few minutes before Jerome comes on and show you guys some features. All right, so now we're starting to wipe out some lows here. That's interesting. Wonder if Max Payne is kind of like take out all the stops below all the lows and then turn it back around. If they're gonna turn it back around, you know, who knows? I don't know. They're going for it though. On the Qs, they're going for these lows. Imagine how many stops are below these lows that they're gonna try and tag. They're doing it on IWM as well. Here they go. So they're taking out all the stops below this low. They're trying on the Qs here. SPY didn't quite make it. They took out all the stops below this low. So this is something to watch. Now the question is can Jerome come in, white knight, save the day? You know, Perry, this is crazy action, but man, this is not nearly as crazy as yesterday. Yesterday's move was bonkers on CPI. So you see how they did that, y'all? They came in and they swiped stops. And now they're bouncing just after they go in and take out all the stops. It's classic. So it's really going to be up to Jerome. Now what we know, remember what we know about Jerome is that he doesn't like the markets being hot here. He wants the markets lower. So it's something to keep in the back of your mind. He's been saying for a long time, you know, the markets, the economy en masse can handle our rate raises. So who knows? He may, we don't know what he's going to say. Santa Rally coming, load the dip. Is a fake out. Yeah, you might be right. You might absolutely be right. Yeah, so they went in, they scooped all of the lows. Yeah, I mean, it kind of feels a little bit like a fake out. It kind of does. I mean, we won't know until things kind of rest, you know, and it's going to take a little time. France scored. No change in the VIX. So that's interesting. We got 25 minutes until Jerome comes on. Now, one thing I'm going to ask for y'all's help with. In the past couple times we've done one of these FOMC shows, there's been an issue with the live stream from Jerome. I will do my best to mitigate it if there is another issue. But if this particular, the one that's above me, if this particular one has trouble, if y'all can hit me with a link to one that's working, that would be awesome. And then I could just flip them out real quick. But we'll worry about that when the time comes. Not too concerned with it right now. Short sellers are strong despite better than expected CPI. The market tumbled at open, getting back into downtrend on the weekly chart. Interesting, Devin. So my guess, things are going to hang out down here. We're not going to see a big bounce just yet, if there's one coming. I don't think we're going to see much action until Jerome. Pretty much the exact same view across all of the indices here. They're really trying to hold it. One thing, one tool that I use kind of religiously on the platform, just in general, is anchored VWAPs. I'm not sure if anybody is interested in those, but you can create anchored VWAPs on any candle by right-clicking on it. And one thing that Brian's the guy who created the anchored VWAP, one thing he always says is you want to anchor VWAPs from kind of pivotal moments on the chart. So, you know, like the first candle on the CPI print or the first candle here on the FOMC print. So I'm going to right click and create some anchored VWAPs here, just kind of from these highs just before the print. Because where price is relative to those levels is really important. Because right now, everybody who kind of bought during that time is losing on the trade, right? Your volume weighted average price is above the current price. So that means that based on volume, where your average buyer is, they're losing here. So really, the first thing that you really need to see happen is you need to see price get above those levels. If we go to the Qs, they just took out the lows here on the Qs. They definitely took out the lows on IWM. We knew that IWM was the most bearish positioning of all of them. They're going for the lows here on SPY. Lows have been hit. Now let's see what they do. If you're a strat trader, this would be like an exhaustion point. This would be a place where many, many, many stops are. So you would definitely expect this to happen. You would definitely expect the bounce here. Now where it comes is tricky, right? IWM, it came what, a dollar lower than the low. On SPY, they've just barely taken out the lows and they're trying to bounce it on QQQ, it's a little bit different. Like each one is a little bit different. The VWAP ribbons are nice too, because they give you kind of like an area as opposed to, you know, as opposed to just one point. Nice bounce off of that low. You guys trading this, or are you just kind of watching, hanging out, letting it happen? Is VWAP the same as linear regression channel? No, I would say no. I'm not super familiar with linear regression channel. I would also assume that those levels can align from time to time, but no, they're definitely not the same. VWAP is just volume weighted average price. And an anchored VWAP is just a volume weighted average price anchored from a particular point. So you're defining where the measurement starts. Adding a VWAP, Chanel, or Snahal. Snehal. Just right click on a candle to add an anchored VWAP. So you right click. When you right click on a candle, you get a huge list of different anchored tools that you can add. And the one you're going to want to select is Alpha Trends Anchored VWAP. Now you can also add just a standard VWAP on the chart using just the indicator list here. But since this is an anchored tool, this is one of the ways that you can anchor, is you can just right click on a candle. Just makes it a lot more efficient. So yeah, that's interesting. VIX, J-Man, VIX is not up very much. You're welcome, sir. VIX is not up very much. Absolutely, RJ. This is definitely being recorded. You can absolutely watch it back. VIX is not moving much, but price certainly is. All right, so now we're getting a nice move. Let's see what they could do into the VWAP here. Check out IWM coming right into the anchored VWAP and getting rejected. And this isn't a surprise. These sorts of things are kind of what you expect. At least the initial tests. Doesn't always happen. Or it doesn't always hold, right? Price can jam right through this. We're not talking about a lot of buyers here, but it is interesting to be able to know where our buyers are from this point, because that's going to definitely affect price action. You got a bunch of people who were losing on this trade. Price came back into where they were even, and they sold, right? That's why you see this big wick and price come back in. It's because you had a bunch of traders who were losing on the trade. They got back to break even. They sold. So we got about 17 minutes before Jerome starts speaking. I don't know if he's going to save it. I don't know what he's going to say. It'll be interesting to hear his tone. But while we wait, do you guys want to continue just watching this? Do you want me to kind of show you a couple of new little things we got going on the platform? I'm happy to do either or. I want to do what you guys are interested in. If you guys would prefer just to keep an eye on charts, we can absolutely do that. Also, I'm curious to know, all right, so see, now we got price gaining, VWAP on the Qs, on IWM. I'll tell you what, let's do this. JP has not spoken. JP still has to speak. Larry, you want to see some new stuff? Jack wants to see some new stuff. May wants to keep it here on the charts. Oh, the chat state. Oh, okay. The chart. Well, so I want to show you some new features, but I would need to go back to the individual name. Hold on. You're listening to him on CNBC? Is it current? Is he speaking right now? Because I've got it live. I've got it playing here, just above me. This is going to be his like official speech up here. Well, that's frustrating. Can you hit me with a link? Well, the market reacted because the announcement. But we're looking for specifically the press conference. Oh, you have to be a CNBC subscriber. Tricky. Okay. Well, I guess I can't share that with you guys. I'm sorry. I would love to hear what he's saying right now. But he is going to come on here in 15 minutes. He is going to be live. So whatever he's saying now, I guess, is just different from the official presser. Of course, he is the guy that does the announcement, right? He is going to be the guy that says what they're raising. But what we're going to watch is the press conference. So we're going to, that's where the tone comes into play, right? We kind of all expected 50 bips, but we don't know what he's going to say about it. We don't know how he's going to feel. And that's really what's key here, right? The market already pretty much anticipated 50 bips. Now, did it absolutely price it in? You could argue it didn't, right? Because we had this big down move. But we knew it was coming. What we don't know is the tone he's going to deliver in his speech. Is his tone going to be more dovish? Is his tone going to be more hawkish? Those are the things that are going to paint the picture looking out a month, 2 months, essentially until the next FOMC meeting. Is what does his tone say? The last time there was an FOMC meeting, he came off like I said, he came off quite more dovish than the past 5, right? He has been hardcore about getting inflation under control up until this past one. And this past one, he was much more lackadaisical. He was much more loose. He seemed pleased with the work that they were doing. He seemed pleased about the effect it was having. I'm not doubting you that he was speaking. I'm not doubting you at all. But it kind of feels like, yeah, I'm kind of expecting a little bit of dovishness too. It would be weird for him to like go from being ultra hawkish to starting to feel more dovish to then all of a sudden flipping back to ultra hawkish. It'd be kind of weird. But also we know that if he comes off dovish, markets are likely going to continue rallying, which don't know if that's what he wants. So tricky. It's so tricky. All right, so SPY, we're still trading below that anchored VWAP from the move. Qs as well. You guys see how this is, this is just one simple tool, but it's really, really powerful when you use it this way. When you anchor it from a very specific point in time that is an important point in time. Think of like a earnings announcement, whether it's good or bad. If a really powerful, or if an earnings announcement affects price action really powerfully, that's a really great place to anchor from as well, because it just represents kind of a new reality of a stock. So SPY is just consolidating, Q is just consolidating below that VWAP, IWM consolidating, trying to consolidate above it, which is interesting because IWM was the first to move lower. And it actually, it gave up the most relative to the previous low. If we look at that, I guess they're all pretty darn close. But they all pretty much did exactly that. They came for these lows, tons of liquidity, stops below these lows. They came for the lows, found support, took out all the stops, turn it right back around. If you're a trader that likes to set stops, that's something you have to be really, really, really careful of. Because this is a very, very like logical place, right, to put them, is just below a major low. But oftentimes just below that major low is where they come for, and then they turn it back around. Now, whether or not it holds, who knows, right? But just something that I've kind of realized over time. Something to be really careful about if you are setting stops, and you should. RJ, I'm with you, man. I'd love to see it. Love to see it. So we got about 10 minutes. And something that I kind of want to talk about before Jerome gets on is this idea of, are we getting close? Are we getting close to a bottom? We've got, there's lots of opinions out there. There are many, many opinions that say, hey, there's no chance we're getting close to a bottom. We've got another $70 on the Qs to go, whatever, There are opinions on either side of the spectrum. And I'm not gonna suggest what my opinions are. I really don't know. But, part of the process when it comes to trading, at least for me, is removing opinions and just kind of looking at the facts, right? And one of the ways that I would, and I've kind of showed you a handful of them already, using the auto fibs tool, using the auto trends, using market breadth, using unusual options, using seasonality, all of these things that are available on TrendSpider to kind of help me gauge. One of the ways that I really like to use, and I've really kind of just discovered this recently, but I want to share it with y'all if you're interested in kind of learning about it. I think what we're going to have to do is we're going to have to push the new features to the end after Jerome speaks. So anybody who's interested in seeing some of the really cool new stuff that TrendSpider can do, please stick around after Jerome's talk. I'll be happy to walk through some of that stuff. We'll look at some new chart patterns that are automatically discoverable, some scanning for those chart patterns. But the big thing that I want to share, if anybody is interested in it, is this new scanner that I've created. And what it looks for, it takes into account this idea of something called a power trend. And I'll dig into kind of what makes up a power trend after Jerome's speech. It takes into account this idea of a power trend. And so I'm running this scan every day because not only do I want to see what names are meeting the criteria, but I also want to know like how many names are coming up on this scan. If more and more names continue to be coming up on this scan, then things are looking pretty good, because it's kind of more of a long-term, it's looking for longer term developments in a ticker. It's not just short, quick stuff. It kind of takes time for tickers to develop into meeting this criteria. But what it's really, really looking for is leadership, true, honest leadership. And if we're near a bottom right now, which again, I'm not saying that we are, I don't know, but if we're near a bottom right now, then what I would expect is I would expect this particular scan to continue yielding more and more names. And I would be looking at these names as potential kind of longer term investments, the strongest of the bunch that I can trade from, right? And that's really what I've been using it for. I've been using it to find names that are really bucking the bear market trend as of late. Now, of course, it's easier for names to come up when, the past 2 months on the indices have been relatively strong, right? We've seen a nice move over the past couple of months. So it's easier for names to meet that criteria. As time continues on though, let's say the market heads lower. names that appear in this particular scan are going to be the strongest of the bunch. You would assume then that the names that are the strongest of the bunch, when the market catches tailwinds, those names are going to be the first to really get going. And there, in a lot of cases, there are a bunch of names that I don't know, that I've never really heard of, and I've never really paid attention to. They are not the old bull market leaders of 2020, 2021. These are all exciting new names that clearly somebody is paying attention to. And I finally found a way to find them, and I want to share it with you guys. So please, if you are a TrendSpider user and you would like to learn about this particular tool, I'd love to share it with you, and I'll be happy to do so. We'll talk through kind of how it works. We'll look at a bunch of the names. There are some of the names that are coming up in the scans. I just think it's really cool because I've kind of sought this for some time, and now is a great time. Now is kind of the best time to start finding those names. If we're getting into a bottom right now, which again, you could argue that we are, you could argue that we aren't. If we are, though, traders, investors are going to be looking for the tickers that are going to be the new leaders. And this particular scan is a really cool way of finding them. And I can't wait to share it with you guys. So do stick around after Jerome, and I will hook you up with that scanner and we'll talk about it. Let me look at some questions that have come in here. Devin, 5-minute on SPY looks like a bear flag. Yeah, I mean, potentially. IWM is really holding on to that anchored VWAP from those from the start of this move. SPY and the Qs look pretty much the darn same. You certainly could be right, Joel. Certainly could be right. If that's the case, though, you know, like if there's just a retracement and we end up holding higher lows, again, that's even more reason to like be seeking these next leaders. That's really kind of where my head's at anyway. I'm a trader at heart. I love trading futures, but you know, as traders, we try and diversify with accounts and things, and you know, if I'm thinking that there might be a new bull market at some point in the next year, year and a half, something like that, those bull markets can last, you know, a pretty decent amount of time. I want to be in names that are going to be powerful over the longer term. So that's why I'm so stoked about this particular scan, because it just, you know, kind of, I most of my job is spent researching, and I just stumbled upon this kind of idea, and it was just really, for me, it was very simple to, you know, the one of the greatest tools on the platform is the scanner. And the reason why it's so great, I am not technically savvy in any way, shape, or form. You don't have to write code to run scans on our platform. You can scan for all kinds of different things. It's just really easy to manage. Let me see here. I went long on a cheap SPY call. Good luck, RJ. I hope that Jerome comes in and saves the day. Do I have a tool that can easily show non-Santa rallies in December? Yeah, I mean, seasonality, man. Does it consider fundamentals like dividends? Good question. It does not. All right, so we got Jerome here. He's coming. We got 2 minutes. And again, like I said, you guys, if anybody is interested in sticking around after, we've done these quite a bit. I know that a lot of you guys are just here to watch Jerome. But if you're interested in learning kind of some more specifics about the TrendSpider platform, I'm going to hang out after. I'm going to answer any questions you guys have about the platform. I'm going to share that really killer new scan that I figured out with you guys, show you a couple of the new tools that we're working on that are available on the platform. Yeah, would love for all y'all to stick around. And also, before Jerome starts, truly, thank you guys for being here. Really appreciate it. There's a good lot of you here, so thank you. Thank y'all for hanging out with me, choosing our channel instead of somebody else's. All right, he's stepping up to the podium. Well, where is it? All right, so let me do this real quick. All right, we're turning off that music. I'm going to go to the alternative player because clearly it's not up here. All right, we're going to full screen it. All right, now I need to know, you guys, can you hear the music piping in from FOMC well? Because that'll mean we can hear Jerome. Here we go. Good luck, guys. If anybody has any issues with the music, with the volume, just let me know. Yeah, he hasn't started speaking yet. A, B, C, D. Here he comes.
Good afternoon. Before I go into the details of today's meeting, I'd like to underscore for the American people that we understand the hardship that high inflation is causing, and that we are strongly committed to bringing inflation back down to our 2% goal.
Everybody hear that?
Over the course of the year, we've taken forceful actions to tighten the stance of monetary policy. We've covered a lot of ground, and the full effects of our rapid tightening so far are yet to be felt. Even so, we have more work to do. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy doesn't work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised our policy interest rate by a half percentage point. We continue to anticipate that ongoing increases will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. In addition, we're continuing the process of significantly reducing the size of our balance sheet. Restoring price stability will likely require maintaining a restrictive policy stance for some time. I'll have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy has slowed significantly from last year's rapid pace. Although real GDP rose at a pace of 2.9% last quarter, it is roughly unchanged through the first 3 quarters of this year. Recent indicators point to modest growth of spending and production this quarter. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. As shown in our summary of economic projections, the median projection for real GDP growth stands at just 0.5% this year and next, well below the median estimate of the longer-run normal growth rate. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate near a 50-year low, job vacancies still very high, and wage growth elevated. Job gains have been robust, with employment rising by an average of 272,000 jobs per month over the last 3 months. Although job vacancies have moved below their highs and the pace of job gains has slowed from earlier in the year, the labor market continues to be out of balance, with demand substantially exceeding the supply of available workers. The labor force participation rate is little changed since the beginning of the year. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on wages and prices. The median projection in the SEP for the unemployment rate rises to 4.6% at the end of next year. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in October, total PCE prices rose 6%. Excluding the volatile food and energy categories, core PCE prices rose 5%. In November, the 12-month change in the CPI was 7.1%, and the change in the core CPI was 6%. The inflation data received so far for October and November show a welcome reduction in the monthly pace of price increases. But it will take substantially more evidence to give confidence that inflation is on a sustained downward path. Price pressures remain evident across a broad range of goods and services. Russia's war against Ukraine has boosted prices for energy and food and has contributed to upward pressure on inflation. The median projection in the SEP for total PCE inflation is 5.6% this year and falls to 3.1% next year, 2.5% in 2024, and 2.1% in 2025. Participants continue to see risks to inflation as weighted to the upside. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a half percentage point, bringing the target range to 4.25% to 4.5%. And we are continuing the process of significantly reducing the size of our balance sheet. With today's action, we have raised interest rates by 4.25 percentage points this year. We continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. Over the course of the year, financial conditions have tightened significantly in response to our policy actions. Financial conditions fluctuate in the short term in response to many factors, but it is important that over time they reflect the policy restraint that we're putting in place to return inflation to 2%. We are seeing the effects on demand in the most interest-sensitive sectors of the economy, such as housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In light of the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation, the committee decided to raise interest rates by 50 basis points today, a step down from the 75 basis point pace seen over the previous 4 meetings. Of course, 50 basis points is still a historically large increase, and we still have some ways to go. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 5.1% at the end of next year, a half percentage point higher than projected in September. The median projection is 4.1% at the end of 2024 and 3.1% at the end of 2025, still above the median estimate of its longer run value. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. Our decisions will depend on the totality of incoming data and their implications for the outlook for economic activity and inflation. And we will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. We are taking forceful steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the long run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I will look forward to your questions.
Steve Leisman, CNBC. Thanks for taking my question, Mr. Chairman. You just talked about the importance of market conditions reflecting the policy restraint you put in place. Since the November meeting, the 10-year has declined by 60 basis points. Mortgage rates have come down. High-yield credit spreads have come in. The economy has accelerated, and the stock market's up 6%. Is this loosening of financial conditions a problem for the Fed in its effort and its fight against inflation? And if so, do you need to do something about that, and how would you do something about that? Thank you.
So as I mentioned, it is important that overall financial conditions continue to reflect the policy restraint that we're putting in place to bring inflation down to 2%. We think that financial conditions have tightened significantly in the past year, but our policy actions work through financial conditions, and those in turn affect economic activity, the labor market, and inflation. So what we control is our policy moves and the communications that we make. Financial conditions both anticipate and react to our actions. I would add that our focus is not on short-term moves, but on persistent moves, and many things, of course, move financial conditions over time. I would say it's our judgment today that we're not at a sufficiently restrictive policy stance yet, which is why we say that we would expect that ongoing hikes would be appropriate. And I would point you to the SEP, again, for our current assessment of what that peak level will be. As you will have seen, 19 people filled out the SEP this time, and 17 of those 19 wrote down a peak rate of 5% or more, in the fives. So that's our best assessment today for what we think the peak rate will be. You will also know that at each subsequent SEP during the course of this year, we've actually increased our estimate of what that peak rate will be. And today, the SEP that we're published shows that, again, that overwhelmingly FOMC participants believe that inflation risks are to the upside. So I can't tell you confidently that we won't move up our estimate of the peak rate again at the next SEP. I don't know what we'll do. It will depend on future data. What we're writing down today is our best estimate of what we think that peak rate will be based on what we know. Obviously, if the inflation data come in worse, that could move up, and it could move down if inflation data are softer.
Gina. Gina Smilik, New York Times. Thanks for taking our questions. The SEP, like you mentioned, suggests that the Fed will be making another 3/4 percentage points worth of rate increases in 2023. I wonder if you would foresee that being in 25 basis point increments, 50 basis point increments, sort of how you see the speed playing out going forward. And then I wonder what you're looking at as you determine when to stop.
Yeah. As I've been saying, as we've gone through the course of this year, as we lifted off and got into the course of the year, and we saw how strong inflation was and how persistent, it was very important to move quickly. In fact, the speed, the pace with which we were moving was the most important thing. I think now that we're coming to the end of this year, we've raised 425 basis points this year, and we're into restrictive territory. It's now not so important how fast we go. It's far more important to think, what is the ultimate level? And then at a certain point, the question will become, how long do we remain restrictive? That will become the most important question. But I would say the most important question now is no longer the speed. So, and that applies to February as well. So I think we'll make the February decision based on the incoming data and where we see financial conditions, where we see the economy, and that'll be the key thing. But for that decision. But ultimately, that question about how high to raise rates is going to be one that we make looking at our progress on inflation, looking at where financial conditions are, and making an assessment of whether policy is restrictive enough. I've told you today we have an assessment that we're not at a restrictive enough stance, even with today's move, and we've laid out our individual assessments of what we would need to do to get there. At a certain point, though, we'll get to that point, and then the question will be how long do we stay there? And the strong view on the committee is that we'll need to stay there, until we're really confident that inflation's coming down in a sustained way, and we think that will be some time. Now, why do I say that? If you look at you can break inflation down into three sort of buckets. The first is goods inflation, and we see now, as we've been expecting really for a year and a half, that supply conditions would get better, and ultimately supply chains get fixed, and demand settles down a little bit and maybe goes back to services a little bit, and we start to see goods inflation coming down. We're now starting to see that in this report and the last one. Then you go to housing services. We know the story there is that housing services inflation has been very, very high and will continue to go up, actually, as rents expire and have to be renewed. They're going to be renewed into a market where rates are higher than they were when the original leases were signed. But we see that the new leases that the rate for new leases is coming down. So once we work our way through that backlog, that inflation will come down sometime next year. The third piece, which is something like 55% of the index, PCE, core inflation index, is non-housing related core services. And that's really a function of the labor market largely. The biggest cost by far in that sector is labor. And we do see a very, very strong labor market, one where we haven't seen much softening, where job growth is very high, where wages are very high, vacancies are quite elevated, and really there's an imbalance in the labor market between supply and demand. So that part of it, which is the biggest part, is likely to take a substantial period to get down. The goods inflation has turned pretty quickly now, after not turning at all for a year and a half. Now it seems to be turning, but there's an expectation really that the services inflation will not move down so quickly, so that we'll have to stay at it, so that we may have to raise rates higher to get to where we want to go. And that's really why we are writing down those high rates and why we're expecting that they'll have to remain high for a time.
Howard Schneider with Reuters. Thanks for taking the question. You described GDP growth in the SEPs as moderate or modest, I believe. Yet it's really approaching stall speed. Half a percentage point is not much. You described labor market unemployment rate as representing some softening, but it's nearly a full percentage point rise, and that's well in excess of what has historically been associated with recession. Why wouldn't this be considered a recessionary projection by the Fed?
Well, I'll tell you what the projection is. I don't think it would qualify as a recession, no, because you've got positive growth. The expectations in the SEP are basically, as you said, which is we've got growth at a modest level, which is to say about a half a percentage point. That's positive growth. It's slow growth. It's well below trend. It's not going to feel like a boom. It's going to feel like very slow growth, right? In that condition, labor market conditions are softening a bit. Unemployment does go up a bit. I would say that many analysts believe that the natural rate of unemployment is actually elevated at this moment. So it's not clear that those forecasts of inflation are really much above the natural rate of unemployment. We can never identify its location with great precision. But that 4.7% is still a strong labor market. If you look, you've got the reports we get from the field are that companies are very reluctant to lay people off, other than the tech companies, which is a story unto itself. Generally, companies want to hold on to the workers they have because it's been very, very hard to hire. So, and you've got all these vacancies out there far in excess of the number of employed people. That doesn't sound like a labor market where a lot of people will need to be put out of work. So that there are channels through which the labor market can come back into balance with relatively modest increases in unemployment, we believe. None of that is guaranteed, but that is what their forecast reflects.
Nick. Thanks, Nick Timmeros of the Wall Street Journal. Chair Powell, I want to follow up on Gina's question. The decision to step down the pace of rate rises appears to have been socialized at your last meeting, largely before the past two CPI reports showed inflation decelerating in line with the committee's forecast this year. You just now talked about making decisions meeting by meeting and being mindful of the lags of policy. Does that mean, all things equal, you would feel more comfortable probing where the terminal rate is by moving in 25 basis point increments, including beginning at your next meeting?
So I haven't made a judgment on what size rate hike to make at the last meeting. But what you said is broadly right, which is having moved so quickly and having now so much restraint that's still in the pipeline, we think that the appropriate thing to do now is to move to a slower pace. And that will allow us to feel our way and and get to that level, we think, and better balance the risks that we face. So that's the idea. It makes a lot of sense, it seems to me, particularly if you consider how far we've come. But again, I can't tell you today what the actual size of that will be. It will depend on a variety of factors, including the incoming data in particular, the state of the economy, the state of financial conditions.
With the CPI report, if it had come out last week, do you think it would have changed some of those forecasts in today's S&P?
No, absolutely not. No, as just a matter of practice, the SEP reflects any data that comes out during the meeting, and participants know that that they can make changes to their SEP during the meeting, well in advance of the press conference, so that we're not running around. But that's not the case. It's never the case that the SEPs don't reflect an important piece of data that came in on the first day of the meeting.
Thanks. Rachel?
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thank you for taking our questions. I'm wondering if we could talk about the projection for the unemployment rate. Why has the Fed raised its unemployment projection? Is it because the model suggests that a higher terminal rate would automatically cause a higher unemployment rate? Or are you seeing signs that the labor market isn't quite as strong as we think it is now? Thanks.
No, it's not about the strength of the labor market. The labor market is clearly very strong. It is more just that, by now, we've continually expected to make faster progress on inflation than we have ultimately, and that's why the peak rate for this year goes up between this meeting and the September meeting. You see the fact that we've made less progress than expected on inflation, so that's why that goes up, and that's why unemployment goes up, because we're having to tighten policy more. And so it didn't go up by much in the media, I don't think, but that's the idea, is slower progress on inflation, tighter policy, probably higher rates, probably held for longer, just to get to where the kind of restriction that you need to get inflation down to 2%.
Do you have a sense of, in order to get to that number, how much of that could be caused by layoffs versus vacancies trimming or changes to the labor force population rate?
So it's very hard to say. You can look at history, right? And history would say that in a situation like this, the declines in unemployment would be more meaningful, I think, than what you see written down there. But why do we think that is the case? So I'll give you a few reasons. First, just is that there's this huge overhang of vacancies, meaning that vacancies can come down a fair amount, and we're hearing from many companies that they don't want to lay people off, so that they'll keep people because it's been so hard. I mean, I think it feels like we have a structural labor shortage out there, where there are 4 million fewer people, a little more than 4 million, who are in the workforce available to work than there's demand for workforce. So the fact that there's a strong labor market, means that companies will hold on to workers, and it means that it may take longer, but it also means that the costs in unemployment may be less. Again, that we're going to find out empirically, but I think that's a reasonably possible outcome, and you do hear many labor economists believe that it is. So we'll see, though.
Colby?
Thank you. Colby Smith with the Financial Times. How should we interpret the higher core inflation forecast for 2023 in the SEP? Does that not then suggest that the policy rate currently forecasted for next year should actually be higher than the 5.1 medium estimate penciled in?
Well, I think that's why one of the reasons it went up was that core came in stronger this year. Yeah, what you see is our best estimate as of today, really, for how high we need to raise rates, to how much we need to tighten policy to create enough, restrictive policy to slow economic activity and soften the labor market and bring inflation down through those channels. That's all. That is the estimate, best estimate we make today, and as I mentioned, we'll make another estimate for the next SEP, and we'll, of course, between meetings we do the same thing, but we don't publish it.
Victoria.
Hi, Victoria Guida with Politico. I wanted to make sure I understand specifically what's going on in the SEP, because you all expect rates to go higher, but you're also more pessimistic about what inflation is going to look like next year. And I was just wondering, given that we have seen some cooling in inflation, is that primarily because of wage growth, that you expect wage growth to be sort of a headwind?
No, we're going into next year with higher inflation than we had thought, right? So we're actually moving down to the level that we're moving down to next year is still a very large drop in inflation from where inflation is running now, well more than a 1% change in inflation. But remember that the jump-off point at the beginning of the year is higher. So we're moving down still by a very large chunk. I don't think the policy's having any less effect. It's just starting from a higher level at the end of 2022. So we're getting down. I believe the median is 3.5%. That's a pretty significant drop in inflation. And where's it coming from? It's coming from the goods sector, clearly. By the middle of next year, we should begin to see lower inflation from the housing services sector. And then, the big question is how much will you see from the largest, the 55% of the index, which is the non-housing services sector. And, that's where you need to see, we believe you need to see a better balancing of supply and demand in the labor market, so that you have, it's not that we don't want wage increases. We want strong wage increases. We just want them to be at a level that's consistent with 2% inflation. Right now, if you factor in productivity estimates, standard productivity estimates, wages are running, well above what would be consistent with 2% inflation.
Neil.
Thanks. Hi, Chair Powell. Neil Irwin with Axios. Some of your colleagues have been pretty explicit that they can't imagine rate cuts happening in 2023. That's certainly not implied by the SEP. But futures markets have priced in some easing in the back half of next year. What's your view of the likelihood of any kind of rate cuts next year? What circumstances might make that plausible?
Our focus right now is really on moving our policy stance to one that is restrictive enough to assure a return of inflation to our 2% goal over time. It's not on rate cuts. And we think that we'll have to maintain a restrictive stance of policy for some time. Historical experience cautions strongly against prematurely loosening policy. I guess I would say it this way. I wouldn't see us considering rate cuts until the committee is confident that inflation is moving down to 2% in a sustained way. So that's the test I would articulate. And you're correct. There are not rate cuts in the SEP for 2023.
Steve Matthews with Bloomberg. Let me ask you about China. In the last few weeks, China has abandoned its COVID policy and been reopening pretty strongly. I'm wondering if you see that as disinflationary because you're seeing supply chains improve, or inflationary because it obviously brings a lot more demand globally, improves the global outlook for growth and for commodities prices.
So you're right. Those two things will offset each other. Weaker output in China will push down on commodity prices, but it could interfere with supply chains ultimately, and that could push inflation up in the West. It's very hard to say, how those two will offset each other, and it doesn't seem likely actually that the overall net effect would be material on us. But to your point, China faces a very challenging situation in reopening. We've seen waves of COVID all around the world can interfere with economic activity. China, a very critical manufacturing place for manufacturing and exporting. Their supply chain is very important. China faces a reopening. They've backed away from their COVID restriction policies. There could be very significant increases in COVID, and we'll just have to see. It's a risky situation. But again, it doesn't seem like it's likely to have material overall effects on us.
Chris.
Hi, Chris Rugaber, Associated Press. Thank you for taking my question. I wondered if you could comment a bit more about yesterday's inflation report. I mean, it showed inflation cooling in all three of the categories that you laid out at Brookings. Are you confident that you're seeing real progress on getting inflation under control? Are you still worried it could slip into some kind of unentrenched, upward spiral? Thank you.
Right. So the data that we've received so far for October and November, we don't have we have some remaining data to get in November, but they clearly do show a welcome reduction in the monthly pace of price increases. As I mentioned in my opening statement, it will take substantially more evidence to give confidence that inflation is on a sustained downward path. So the way we think about this is this. This report is very much in line with what we've been expecting and hoping for. And what it does is it provides greater confidence in our forecast of declining inflation. As I mentioned, we've been forecasting significant declines in overall inflation and core inflation in the coming year, and this is the kind of reading that it will take to support that. So really this gives us greater confidence in our forecast rather than at this point changing our forecast. In terms of the pieces, we have been expecting goods inflation to come down as supply chain pressures eased. That's happening now. Housing services, as I mentioned, there is good news in the pipeline. As long as new housing leases show declining inflation, that will show up in the measure around the middle of next year, so that should help. And the big piece, again, is core services ex housing, which is very important, and we have a ways to go there. You do see some beginning signs there, but ultimately that's that more than half, as I mentioned, of PCE core index, and it's very fundamentally about the labor market and wages. If you look at wages, look at the average hourly earnings number we got with the last payrolls report, you don't really see much progress in terms of our average hourly earnings coming down. Now there may be composition effects and other effects in that, so we don't put too much weight on any one report. These things can be volatile month to month, but we'll be looking for wages moving down to more normal levels where workers are doing well and ultimately their gains are not being eaten up by inflation.
Michael.
Michael McKee from Bloomberg Radio and Television. There's a little bit of a disconnect between the optimistic view you just expressed about the economy and the changes that you've made in the SEP. And I'm wondering if you're reacting to the fact that the markets have loosened financial conditions, or if you feel the Fed may be a little bit behind on inflation, whether the recent disinflation we're seeing is transitory or not, and how this affects the idea of a soft landing if you're projecting just 0.5% growth for this year.
So if I think I got your question. So, one thing is to say is I think our policies in getting into a pretty good place now. We're restrictive, and I think we're getting close to that level of sufficiently restrictive. We laid out today what our best estimates are to get there. It boils down to how long do we think this process is going to take? And of course, we welcome these better inflation reports for the last 2 months. They're very welcome, but I think we're realistic about the broader project. So that's all. That's the point I would make. It's, we see goods prices coming down. We understand what will happen with housing services, but the big story will really be the rest of it, and there's not much progress there, and that's going to take some time. I think my view and my colleagues' view is that this will take some time. We'll have to hold policy at a restrictive level for a sustained period, so that two good monthly reports are very welcome. Of course, they're very welcome, but think we need to be honest with ourselves that there's, inflation, 12-month core inflation is 6% CPI. That's 3 times our 2% target. Now, it's good to see progress, but let's just understand we have a long ways to go to get back to price stability.
Well, do you think the soft landing is no longer achievable?
No, I wouldn't say that. No, I don't say that. I mean, I would say this, to the extent we need to keep rates higher and keep them there for longer and inflation, moves up higher and higher, I think that narrows the runway. But lower inflation readings, if they persist in time, could certainly make it more possible. So I don't think anyone knows whether we're going to have a recession or not. And if we do, whether it's going to be a deep one or not. It's not knowable. And certainly, lower inflation reports, were they to continue for a period of time, would increase the likelihood of a, so I would put it this way, of a return to price stability that involves significantly less of an increase in unemployment than would be expected given the historical record.
Ryan.
Hi, Chairman Powell. Brian Chung, NBC News. You warned Americans of pain earlier this year as the Fed hikes rates, but with the Fed now expected to raise rates higher than you thought when you first said that, just wondering where we are in that pain. How would you describe that to Americans if the projections on unemployment find themselves? That would be 1.6 million Americans out of jobs.
So the largest amount of pain, the worst pain, would come from a failure to raise rates high enough and from us allowing inflation to become entrenched in the economy so that the ultimate cost of getting it out of the economy would be very high in terms of unemployment, meaning very high unemployment for extended periods of time, the kind of thing that had to happen when inflation really got out of control and the Fed didn't respond aggressively enough or soon enough in a prior episode, 50 years ago. So that's really the worst pain would be if we failed to act. What we're doing now is, it's raising interest rates for people. And so people are paying higher rates on mortgages and that kind of thing. There will be some softening in labor market conditions. And I wish there were a completely painless way to restore price stability. There isn't. And this is the best we can do. I do think, though, that and markets are pretty confident, it seems to me, that we will get inflation under control, and I believe we will. We're certainly highly committed to do that.
Grady.
Thank you, Mr. Chair. Grady Trimble with Fox Business. You've reiterated today, and the committee has reiterated its commitment to that 2% inflation target. I wonder, is there ever a point where you actually reevaluate that target and maybe increase your inflation target if it is stickier than even you think it is?
That's just so changing our inflation goal is just something we're not thinking about. It's not something we're not going to think about. We have a 2% inflation goal, and we'll use our tools to get inflation back to 2%. I think this isn't the time to be thinking about that. I mean, there may be a longer run project at some point, but that is not where we are at all. The committee, we're not considering that. We're not going to consider that under any circumstances. We're going to keep our inflation target at 2%, and we're going to use our tools to get inflation back to 2%.
Nicole.
Thank you, Chairman Powell. Nicole Goodkind, CNN Business. As you monitor wage growth and unemployment data, I wonder if you're paying close attention to a sector or even income level. Like, how do you factor potential exacerbations of inequality into your risk calculations, especially given the K-shaped recovery of 2020?
So I would go back to the labor market that we had in 2018, 19, 20. So what that looked like was wage increases for the people at the lowest end of the income spectrum were the largest. The gaps between racial groups and gender groups were at their smallest in recorded history. All of that because of a tight labor market. A tight labor market which had inflation running, just a tick below 2%, and the economy growing right at its potential. So that seems like something that would be really good for the economy and for the country if we could get back to that. And so that's what all of us want to do. We want to get back to a long expansion where the labor market can remain strong over an extended period of time. That's a really good thing for workers in the economy, and we'd love to get back to that. That's what our goal is. There's in the near term, we have to use our tools to restore price stability, but we can't. What we have to think about is the medium and longer term. If you think about it, the country went through a difficult time. I think much more difficult than we can think it would happen here, but it really set up our economy for several decades of prosperity. So price stability is something that really pays dividends for the benefit of the economy and the people in it over a very, very long period of time. And so when it is lost for whatever reason, it has to be restored, and as quickly as possible, which is what we're doing.
In the short term, are you factoring in these potential exacerbations in the economy? Are you monitoring that?
We do, yes, we absolutely do. We look at, it's our regular practice to talk about unemployment rates by different groups, including racial groups and that sort of thing. We do. We keep our eye on that.
Nancy.
Hi, Nancy Marshall-Genzer with Marketplace. What would you do if the economy slows so much that we enter a recession before we see strong, consistent signs that inflation is slowing? In other words, stagflation.
So I don't want to get into too many hypotheticals, but it's hard to deal with hypotheticals. So let me just say that we have to use our tools to support maximum employment and price stability. I've made it clear that right now the labor market's very, very strong. You're at near a 50-year low. You're at or above maximum employment, in 50-year low in unemployment. Vacancies are very high. Nominal wages are very high. So the labor market is very, very strong. Where we're missing is on the inflation side, and we're missing by a lot on the inflation side. So that means we need to really focus on getting inflation under control, and that's what we'll do. I think as the economy heals, the two goals come more into play. But right now, clearly the focus has to be on getting inflation down.
Greg.
Thank you, Chairman Powell. Greg Robb from MarketWatch. You spoke a little bit ago. You said that the U.S. it looks like we have a structural labor shortage in the economy. Could you expand on that? Talk a little bit more about that. And really, are you talking about getting Congress action on increasing legal immigration, things like that? Thank you.
So what I meant by that, the structural labor shortage, is if you look at where we are now, as I mentioned. If you just look at demand for labor, you can look at vacancies plus people who are actually working, and then you can take supply of labor by are you in the labor market, are you looking for a job or have a job, and you're more than 4 million people short. We don't see, despite very high wages and an incredibly tight labor market, we don't see participation moving up, which is contrary to what we thought. So the upshot of all that is the labor market is actually. It's 3.5 million people at least smaller than it should have been based on pre-pandemic, just assume population and reasonable growth and aging of the population. Our labor force should be 3.5 million more than it is. And that there are lots of easy ways to get to bigger numbers than that if you go back a few more years. So why is that? Part of it is just accelerated retirements. People dropped out and aren't coming back at a higher rate than expected. Part of it is that we lost 500,000 people who would have been close to 500,000 who would have been working, who died from COVID. And part of it is that migration has been lower. We don't prescribe, it's not our job to prescribe things, but I think if you ask businesses, pretty much everybody you talk to says there aren't enough people. We need more people. So I tried to identify that in a speech I gave a month ago, but I stopped short of telling Congress what to do because, they gave us a job and we need to, do that job.
Thanks. Jennifer?
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You say you expect growth of just 0.5% next year. given that you've said the process of raising rates and getting inflation back under control will be painful, have you had discussions within the committee and addressed how long and or how deep of a recession you would be willing to accept?
No. I mean, what we do is we make our forecasts and we publish them quarterly. And you know, if you look at those forecasts, those are forecasts for slow growth, for a softening labor market, by which I mean unemployment goes up, but not a great deal. And you see inflation coming down. You see rates going up a lot. You see inflation coming down. Those are those forecasts, and that's really what they show. We're not. We all, of course, we don't talk about you know, this kind of a recession and that kind of a recession. We make those forecasts. The staff runs, and you will see this if you look at the old Teal books, runs alternative simulations of all different kinds at every meeting, and we look at those too. And those will explore different things. But that's just you know, upside and downside scenarios. Of course, that's responsible practice that we've carried on for many decades. But no, we don't. We haven't asked ourselves that question.
We'll go to Jean for the last question.
Hi, Jean Young with Market News. I wanted to ask about the SEP again. If you are reaching peak rates around 5% in the first half of next year and inflation starts to decline materially, that would seem to make the real rate gradually more restrictive. Is that something that's built into the projections and into models? Is that something you would want to see?
So we do know that, of course. That's something that we know and we'd see. But as I mentioned, that, you know, we wouldn't. I wouldn't see the committee cutting rates until we're confident that inflation is moving down in a sustained way. That would be my test. I don't see us as having a really clear and precise understanding of what the neutral rate is and what real rates are, so that it would mechanically happen like that. It'll be a test of, for cutting rates, I think in the event, it'll be a question of, do we actually feel confident that inflation is coming down in a sustained way? Thank you very much.
I believe that's it. Well, guys, a VWAP from the lows too, absolutely. Let me get some music jamming real quick. Hold on. All right, so what do we think?
What's out there? Out there you'll find new friends, colorful adventures.
Do this real quick. How do you guys feel about that? Do you feel good about it? Do you feel bad about it? I kind of am with y'all based on what I was reading from the comments. That's tricky. He was kind of all over the place from what I could tell. As far as his tone, he didn't really give us, Gary, you feel good? Oh yeah, I'm sorry. You guys said anchor VWAP from the lows. Let's add it. Looks like it's aligning nicely with the VWAP from the high. Yeah, what are y'all's feelings here? It was painful to watch. Yeah, I mean, oh, sorry. Music's too loud. My bad. I'm sorry. Thank you for heads up on that. I appreciate it. Yeah, that was tricky. Because he really was kind of all over the place as far as his tone. Typical nebulous response. I mean, yes, but also, I don't know. That one seemed a little bit more back and forth. We're stoked on this. We're not so stoked on that. We're gonna do everything in our power to continue to bring inflation down. We're encouraged by the numbers. There's a lot of, I don't want to call it doublespeak, but there was just a lot of, you think so, Christoph? You think it was about as bearish as it could be? Yeah, I don't know. So tricky. So tricky. Well, all right. So we've had a bunch of people have left now, and I can't blame you. You guys came here for, or those folks came here for Jerome Powell. Now, I want to speak specifically. We've got a very short amount of time, or not a very short amount of time. We have as much time as we need. But I want to speak to some stuff that I was leading on about before Jerome came on. So I want to show you guys a little bit of new stuff that we've got working on, or that we've just recently added to the platform. And then I want to give you guys that scanner. So if we have TrendSpider users here, you might be interested to stick around. I'm going to, if it's okay with you guys, I'm going to go ahead and switch back to the single chart view here. And the thing that I want to showcase, the feature I want to showcase, ahead of hooking you guys up with that scanner that I'm really digging right now, is the auto chart patterns. I don't know if you guys have played around with this yet, but we've got a handful of really cool new automated chart patterns. You're going to see the button there up at the top of your platform. If you have a TrendSpider account, you're going to see the button called Chart Patterns. Now, again, a ton of traders use chart patterns. This is why I think this tool is really powerful. Tons of traders use chart patterns, and in a lot of cases, they're drawing their own, right? And again, this particular tool allows us to not have to draw them on our own. It's going to automatically do it for us. If you click the three dots next to the chart patterns button, you've got double tops, double bottoms, and then triangles, ascending triangles, descending triangles, symmetrical triangles. Now, the triangles feature has been out for some time, so I don't want to spend too much time there. I really want to focus on double top, double bottom. We've got a very, very clear double bottom automatically drawn on the IWM chart here. So everything in green, this is all automatically done by the platform. And what's cool about this is not just the fact that we can see it very easily. I could flip through charts and it would find what it finds. But because this is just an indicator, right? This is just going to draw the most recent double top or double bottom. There's two different ones on the chart. And so it automatically shows it to us. We don't have to think about whether something is or isn't this pattern. But really where I think this feature shines is in the ability to scan for it. So if we go to our market scanner and we go over to our shared scanners list here down at the bottom, if I type in double, we've got all of these shared scanners that you can utilize, right? And being able to see the pattern is one thing, but what's even kind of cooler, in my opinion, is being able to define where we are relative to the pattern. So you'll notice you have your first low. In this particular case, this is a double bottom, right? So you have your first low. This will be kind of bottom number one. And then we have our second low, or bottom number two. And then you have your, what we're calling a support line. The support line is the apex in between the two lows or the two highs. And so we can define price relative to bottom one. We can define it relative to bottom two. We can define it relative to the support line. If you're not familiar with these patterns or how to trade them, generally speaking, what you're looking for, in order for this pattern to actually be like proper, you need to see price trading in the case of a double bottom, you need to see price get above the support level, right? And in the case of a double top, you would need to see price get below the support level. So by being able to define where price is relative to them, super, super simple. You can immediately see the A, B, C, D. Yes. That I'm not going to get into today because that is actually like kind of a separate feature, but I'm so excited about that particular feature. We'll probably do an entire show on it because I'm so stoked about it. But you can scan for this stuff. So we have all of these shared scanners. We have double bottom failed, double bottom in force, double bottom breakout, double top bottom breakout, or breakdown rather, double top failed in force. So in force means that price is within the double top or the double bottom and the support line. It's somewhere in between. If you have a breakout or a breakdown, then price has managed to get above or below the support line, depending if you got a double top or a double bottom. The insert windows are hiding the market scanner. Ah, they are, aren't they? Let me do this. Let me turn this one off. That helps a little bit. I can't, well, let me see. Maybe I can move. Yeah, here we go. Let me move me and make me smaller. How's that? Is that better? That's a little better. Yeah, no problem. So again, shared scans that automatically allow you to scan for all these different setups. Scan for just the double bottom or the double top occurring on the chart, not bringing into account where price is relative to it. You can scan for, again, like I said, you have the in-force, double bottom in-force, double top in-force. That means price is somewhere in between the support line and the top, the double top and double bottom, a double bottom breakout or double top breakdown, meaning price has gotten through the support level. And then what I like to do with these is I like to take these shared scanners, and I really recommend this for kind of anybody. The shared scanners are very, very basic. You know, they're like the basic building blocks. They're meant to show you, this is how I scan for this very basic setup. And then what you really ought to do, or what we encourage folks to do, users to do, is to take this and add to it. Like, for example, if I run this scan, we're looking for, this is the double bottom in force. So this is gonna find all charts that have a double bottom pattern. Let me turn off double tops for now. It's going to find all charts that have a double bottom pattern with price currently in between the support line and the double bottom, right? So we could go through this list and we could see we have double bottom, we have price in between the lows and the support line. So these are all going to, in theory, potentially look quite different. And that's great. You know, you can utilize this to find a lot of different types of setups. But what I specifically like to do is, because as I've said a zillion times, I'm a price action guy. So, you know, for me, where lows have been made, how they've been made relative to each other, or where highs have been made and how they've been made relative to each other. Do we have higher highs? Do we not have higher highs? Do we have lower lows? Do we not have lower lows? And so on. I want to see price at these extremes. That's what I'm really, really interested in. If price is in like somewhere in the middle, I don't really care too much because it's not really actionable for me. However, if price is really, really close to this support level, or if price is really, really close to one of these double bottoms or double tops, that is more actionable. That's way more actionable for me because you know that price, like we saw with just the 1 minute chart on the futures, when price came into those lows, what did you see happen? It swipes the lows and then it bounces however many points. It bounced 60 something points on ES. Like that's a huge move ultimately. And that's where, for me, that's where the capture is. That's where the potential is. So you can take something like this, you can say it is within a range. You can define price relative to a bottom or relative to a support level, as opposed to just saying it's somewhere in between. You can say price is within range, and you can give it a very tight range. You can say price is within 2% or 1% or 1/4% or whatever from a particular swing low or this big support level. By being able to define those things, you can get way, way, way more specific with the setup that you're looking for, right? And of course, it does require a bit of an understanding of what you're looking for. But let's just do this real quick. I'm going to add a parameter. I'm going to say condition. I'm going to say price. We'll say daily close. So I'm just going to use the current price. And I'm going to define this within range of, I'm going to say indicator, say daily. Start typing in double. Oh, you know what? Let me actually, it's a chart pattern. Okay, so price, daily close is within range of, I'm gonna say chart pattern, daily. And you see now you got all of these options, bottom one, bottom two, pattern line. We're not gonna use that here. I'm gonna say support level. So we're gonna say support level. And by plus or minus X%, let's say 2%, right? So we're defining, in the first two conditions, we're defining that there's a double bottom. We're defining that price is less than the support level. However, it is within range of the support level as well. So it's very close to that support level. And you can adjust this to whatever you want. When we run this scan, we're going to get quite less results, but the results that we do get are going to be way more like what we're looking for, right? Here's your support level, here's price right at it, right? And this, for me personally, this is like crazy, crazy powerful. If you are a price action trader, this functionality opens up a lot of scanning functionality that I'm really, really interested in as a price action guy. You could, if you wanted to, like you could define this 200-day moving average relative to this support line. Like for this particular chart, you can see there's the 200-day moving average right here. Here's your support level right here. Like maybe you're interested in knowing where a particular moving average is relative to a double bottom 2 or whatever. You could go wild with this is really what I'm trying to get at. You could go really, really wild with this. And I just love it. I just think it's like such a cool, powerful feature. And of course you can take that and flip that too for the double tops. And this functionality is opening up a lot of additional stuff for the platform. I can't get into it too much. I really want to, but I can't get into it too much. But play around with it because it's just super cool. It's just super, super cool. If you're a TrendSpider user, I think that not only does this help with your analysis visually, because you can just very quickly see that there are two very unique lows here on the chart. They are within a very specific range of one another. That's what makes them a double bottom, or that's what makes it a double top. And then you can also define then price relative to those things. So super, super powerful. The last thing that I want to show you guys, we've been waiting all session for it, is this scan that I have kind of come across. And I came across it randomly. I was searching through Twitter, just kind of scrolling my feed. And I read, somebody that I follow mentioned an article that was written by a trader that I pay attention to, a guy named Mike Webster. If anybody who follows him, I don't know if you guys are interested in his work. He is kind of like, I don't want to define him, but the process that he goes through to find stocks is what's called like a can slim process. I don't know if that's something that you guys are interested in or you pay attention to or you're knowledgeable about, but it is a kind of more longer term investor style of trading. Yeah. Okay. So you guys know those guys, you guys know him. Yeah. So the can slim thing is interesting because of the idea of if we are getting close to a bottom, again, say it 100 times, I'll preface it 100 times. I'm not saying that we are, but I'm saying that if we are, then we want to be looking for leaders, right? We want to be looking for names that are either bucking this trend, either bucking the bear market trend, or are showing relative strength compared to the other names that are out there. And so I read this article and I realized that the conditions that he was defining were very easy to define in our scanner. So I'm going to pull it up here. I just thought this was super, super cool. And we've actually shared it a little bit socially through the TrendSpider Twitter account. So you may have seen this before, but what it defines, I'm going to open this up really big so that you guys can see it. It's just kind of some basic stuff. It says that the EMA, the 21 EMA is above the 50 EMA for 5 candles. This is all daily time frame stuff, so it's pretty simple. So I've got those 5 conditions laid out here. The 21 EMA is greater than the 50 SMA for the past 5 candles, and I've got it defined. First candle, 1 candle go, 2, 3, 4. So that's the first 5 candles that the last 5 candles, 21 EMA is above the 50 SMA. And then we've got price. The low has stayed above the 21 EMA for the past 10 candles. So I've got that defined. Super, super, super easy stuff here, but I'm going to show y'all what it yields. It's crazy. So price, the low, never gets below the 21 EMA. on the daily time frame for the past 10 candles. So that's defined in this section here. Scroll down, the 50 SMA is greater than the 50 SMA 1 candle ago. So he defines it as the 50 SMA is in an uptrend. And specifically his definition is 1 day. And that seems like not enough to me, but I'm not gonna fight the man. He knows what he's talking about. He's done this a long time, a lot longer than I have, and he's a student of this particular style. So I really want to stay true to it, or I wanted to stay true to it. So that's what he said. 50 days in an uptrend. He said 1 day defines that. So SMA 50 is greater than SMA 50 1 candle ago. Easy. Price close greater than open. So he said one green candle. The current candle is green. So price close greater than price open. That's a green candle. And then I added a couple of additional things. I said that the average volume was above 1 million per day. And I said that price was above $20. So share price is greater than $20 a share. And this was just for the purpose of filtering. I don't know if you guys are TrendSpider users or not, but if you are, if you're creating scans, I strongly recommend, if you're not doing this already, I strongly recommend minimums, price or volume or RSI, or, you can really go wild with your minimums. Minimums really help whittle down results. And when it comes to scanning, that's what you want, right? You want results to be whittled down because you want just the most actionable stuff. It's like what we were just talking about with the double top and double bottom chart patterns. I don't really care if price is somewhere in between, but if price is really close to a bottom or really close to that support level, then that really piques my interest. That gets me, that is a potentially actionable spot right now for my style of trading. And that's really what we're all looking for, right? We're all looking for, let's find actionable stuff right now. So, all right, so that's why I always say add your minimums, know your minimums. They don't have to be crazy. They just have to be something. And it could be, like I said, so simple. Mine are price above $20 per share, average volume above 1 million shares per day. I'm just looking for, not penny stocks and stuff that's liquid. That's really all that matters to me. So I'm going to run the scan now that we understand the conditions. And now we're going to get back a big list. Well, presumably a big list. This list has been kind of waxing and waning as time, as I've had it and as I've been playing around with it. But what you're going to find pretty much across the board is you're going to find tickers that are strong. One, you're going to find tickers that are strong, or you're going to find tickers that are coming out of bases. And that is what is key. This brings us always back around to this idea of, are we at a bottom? Well, some stocks absolutely are. No matter what the indices do, there are some stocks that are bottoming right now. That's just the simple and plain of it, right? Like, that's how it works. So the SMAR here, this is a really good example. This thing has been basing since January of this year. It's been going sideways, and it's just now starting to have a big move, breaking out above the 200-day moving averages. This thing is clearly bucking the trend of what's going on the indices, right? And this is what we want to find. We want to find names if we are looking for maybe potential value, longer term potential value, if we're looking for potential opportunities to invest as opposed to short term quick trading. This is a scan that can be used for that. So this is something you can use every day because the conditions are very specific, right? You need 10 days in a row of lows above the 21 EMA. That can very quickly be broken, right? You can very quickly break that low, cut just below it, and then all of a sudden a name is off the scan. And so the names that are going to come up in here, like I said, they're going to be either really powerful names. This is a clear example of a really powerful name. I don't know what happened here. Obviously, we're a little late to the gun on this one, but that's okay. This thing might have been showing up in this scan a week and a half ago. I don't know. It's just meeting all the criteria now. But really what we look for is stuff that looks like this. Stuff that's got these big, nice bases, managing to make higher lows when the indices have not, or whatever, and continuing to bring in these new highs. So I wanted to share this with y'all. I'm really, really excited about this scan. I run it every single day. I usually run it at night to know kind of what's there, to know if any new names have come up that I'm not paying attention to. But I really want y'all, if you haven't played around with it and you are a TrendSpider user and you're interested in these sorts of setups, I think this could be a really, really powerful way of very quickly finding what you might be interested in. And again, not every single name that comes up here is going to look like something that you want to trade or look like something that you want to invest in. Some of these names are going to be very, very extended. And that's okay. Like we can't, I get, we could, in theory, we could absolutely define a lack of extension. We could say, the current price is within range of a 20 candle low or a 50 candle low, and give it a tight range. You could do that. It would be very easy, actually. You could say something like daily price close is within range of, and we'll use indicator and daily, and I'm going to say range and low. Right. And if I say, it's within 5% of the last 20 candles, we need to offset this. We could say that the current price is within range of the 20 candle range low by 5%. So that limits the amount that the extension could have gone, right? So there are almost always ways to filter further, but I don't want to push that, if you're interested in that sort of thing. And really, honestly, for anybody who's watching right now, like if you guys are ever getting hung up on, you have like a scan idea, but you can't quite figure it out, you can always hit me up. My Twitter handle is I always get this wrong. It's right over there at Krutzky Trades. You're welcome to hit me up. I'm more than happy to, help you with creating scans for ideas that you have. I love doing it. I love making these scans on my own, so I'd be happy to help you with yours. Like this is very extended. Like this, for me, this is too far extended. I missed the move with something like Bud. So so this is just to show that this is going to yield several different types of looks. But if you're looking for that stuff that's really starting to bottom, this is a really clean example of something that's starting to bottom. Abercrombie & Fitch here. You have a long period where it goes sideways, it's accumulating. We could even pull up something like accumulation distribution to kind of see, like, how does accumulation distribution look? Is it confirming? Is it making higher lows? Is it making higher highs as price is doing the same? If it's confirming, then that's letting us know that the buyers are actually there, right? So anyway, wanted to share that with you guys, and I want to give you the scan for anybody who doesn't have it. Let me share this. This is a great feature of TrendSpider. Anybody who is a TrendSpider user can share their scans with anybody else who's a TrendSpider user. So here's the link for y'all. If you want it, click on that link, and it's going to bring up a little screen. It's going to prompt you through sharing it, or prompt you through downloading it or uploading it into your platform so that you can utilize it. And that's really what, TrendSpider is all about, right? Like, we're all about trying to create tools that make traders' lives easier. We do not all have the same ideas, but we all have some ideas. I'm here to help you guys with your ideas if you have them. Hit me up with your questions anytime you have them on Twitter. My DMs are open. You're always welcome to shoot me a question. We also have a live support team on staff Monday through Sunday. Those guys are accessible pretty much all the time. They're available via the contact us button. They can do the same thing. They can answer your questions about scans. They can answer any platform related questions that you have. There's a lot of us here to help get you guys feeling good on the platform, especially for people who are new to the platform. There's a ton going on it. There's a ton of tools. It could be easy to have trouble navigating around them. So we really encourage, feel free. Absolutely, Joel, man, please play around with it. And let me know if you find anything cool. I'll try and start posting charts. I've been so focused on futures. I'm just, I haven't been posting a ton of like charts that I find like this, but I should probably start doing that. Maybe I'll start doing that on my feed. So yeah, guys, that's really it for me. I hope you guys found some of this stuff helpful. I hope that you enjoyed hanging out with Jerome Powell. I'd say it's a little unclear. So it's going to be very interesting to see kind of how this all plays out. That's the last FOMC for the year. We have a huge options expiry on Friday. It's the biggest one of the year, as far as I understand. It's a huge one. So please keep your eye on options expiry on the 16th. It is going to affect markets, and I would anticipate markets. There's a chance that markets might kind of trend sideways until after this options expiry, because you have tons of puts, tons of calls, and markets are all about max pain. They might try and pin it somewhere right in the middle of wherever the most puts and the most calls are located. And I believe it's on SPY, it's somewhere between like 410 and 390. So a pin somewhere right around 400 would not be too much of a shocker here going into at least going into Friday, where we're at. We're at 399.40 right now. If we go sideways for the next 2 days, don't be too surprised. I mean, I don't know. I don't want to try and predict what's going to happen, but yeah, RJ, the scanner's free. Absolutely, man. And like I said, please do feel free to hit me up. If you have scanner ideas and you're having trouble scripting them, hit me up. I'm happy to help you with it. That's part of my job. So last thing before I go, Robert, man, I miss him too. I'm not gonna lie, I miss him too. It's always fun coming on with you guys and talking shop. Maybe in the new year we'll start doing those again. I can't really be sure. My role we're still kind of figuring it out. I haven't been doing this super long, so we're still trying to kind of figure out the best way to do these. So maybe we'll bring back some weekly sessions in the new year. I don't really know. You might hear me try and on the back end, I might try and fight for a few more if I can. So it's been great hanging out with you guys. Thank you so much for joining us today. Again, if you have any questions about the TrendSpider platform, you're more than welcome to hit us up via that contact us button. You're more than welcome to hit me up on Twitter. We do have a really killer sale going on right now. So if you're not yet a TrendSpider user, now is a good time to take advantage of the sale. Maybe, as an early Christmas present to yourself, or, you could do that thing where you buy somebody else a Christmas present, but it's really for you. I used to do that all the time when I was a kid for my parents. I'd buy them stuff that I kind of wanted and then give it to them and then borrow it and never give it back. Maybe you want to do that with a TrendSpider account. We've got monthly options, we've got yearly options, and the discounts are quite good right now. So, and I'm also told that prices are going to be going up dramatically next year. So maybe lock in a good deal this year while it's available to you, because it won't be available for much longer. The deals are going to continue into the new year, I think, for like the first week of the new year, and then prices, I believe, are going to increase dramatically. So if you are on the sidelines, you're thinking about being a TrendSpider user, you are not yet one, now is a good time. And then last thing before I go, we do have awesome, Robert, that's so great. I'm so glad that you're digging it. We do have another live stream next week. I'm not going to talk too much about it. You'll be hearing about it. It's going to be another masterclass. We've done masterclasses over the past couple of months. We did one with our friend Bracco. We did last month. We did one with who are we with? Scott Redler and Miss Izzy. They joined us. And this next one is going to be a really cool one. I'm really excited about it. Our guest is such a great guy and such a bright guy. He's got so much valuable market information. So that's going to be next week, next Tuesday-ish. So mark your calendars. It's going to be an evening show. I'm not going to tell you who the guest is, but if you follow us on Twitter, follow me on Twitter, TrendSpider account, you'll see it very soon. So teeing it up for that. And yeah, that's it for me, guys. Again, I really appreciate y'all being here. I hope that you have a great rest of your trading week. Look out for that options expiry. Let the market come to you. Utilize the TrendSpider platform to assist you with all of the tools that it has. Utilize all those tools. They're all there to kind of help you make more educated decisions. Utilize the back tester, utilize the scanner, utilize those periphery tools like seasonality, unusual options. utilize those automated analysis tools. There's all kinds of things here that you can use to kind of just get a better sense of what's going on in the markets. So, and feel free to ask any questions that you have. I hope you guys have a great holiday. And again, like I said, we'll be back next week for a masterclass with a good friend. I can't wait for it. I'm so excited. I wish I could tell you guys who it was, but I can't. So yeah, have a great rest of your week. Pleasure being here with y'all, and can't wait to see you again soon. Take care. As always, happy trading, and we'll catch you next time. All right, have a good one.